Most Americans pay more taxes than they legally have to. Not because they cheat, because they never learned that the tax code has empty space in it every single year. Space you're allowed to fill strategically, legally, on purpose. This video shows you exactly how. David is a 54-year-old electrician in Columbus, Ohio. Good job, solid 401k. He's done most things right, but every April he writes a check to the IRS that leaves him with this quiet, uncomfortable feeling he can't fully explain. Not that he's doing anything wrong, just that somehow the math never quite works in his favor. Last year, his financial planner sat him down and showed him something that changed that feeling permanently. She pulled up his return, pointed to a number, and said 4 words that David had never heard in 30 years of filing taxes. You have room left. Room in his tax bracket. Thousands of dollars of legal space he wasn't using. Space where income could have lived at 12%, but instead sat untouched while other money got taxed at 22%. In one conversation, she showed him how to fill that space deliberately, on purpose, with money that was going to get taxed eventually anyway. And over the next 3 years, that strategy saved David more than $14,000 in federal taxes. He didn't hide anything. He didn't bend any rules. He just learned something that most Americans never get taught, that tax brackets don't fill themselves, and the ones who understand that get to keep more of what they earn. Here's what this video is going to do for you. By the end of the next 15 minutes, you're going to understand exactly how the US tax bracket system works in 2026, not the textbook version, the real version. You're going to see the specific strategies that let you legally move income into lower brackets before the IRS gets to decide where it lands. And you're going to walk away with a clear picture of what this could mean for your own tax bill this year and every year after. The strategies here are used by people who know the tax code well. After today, you'll be one of them. Hi, it's Logan from Logan Wealth, your trusted source for personal finance, investing, retirement planning, taxes, budgeting, inflation, and long-term wealth building strategies. We break down complex financial topics into practical, easy-to-understand insights so you can make smarter money decisions with confidence. Now, let's dive in. Let's start with the thing that confuses almost everyone, and I mean almost everyone, including people who have been filing taxes for decades. Here's the deal. Your tax bracket is not a flat rate on everything you make. Think of the federal tax system like a set of buckets stacked on top of each other. Each bucket fills with income at a specific rate. The first bucket fills at 10%, the next at 12%, then 22%, then 24%, and so on, all the way up to 37%. Here's where it gets interesting. Most Americans earn income and let it land wherever it lands. They contribute to their 401k, they pay their bills, and whatever the tax return says in April, that's the number. Reactive. But a smaller group of people does something different. They look at those buckets before the year ends and ask one question: how much room do I have left in my lower brackets? And then they deliberately put income there. That is the entire strategy. Move money into the cheaper buckets before the expensive ones claim it. Let's talk about exactly how you do that. The most powerful bracket filling tool for most Americans is the Roth conversion. Here's the picture. You have a traditional 401k or IRA. That money has never been taxed. When you pull it out in retirement, every dollar gets taxed as ordinary income. So the question isn't whether it gets taxed, it's when and at what rate. Now picture Sarah. She's 62, recently retired, and won't start Social Security until 67. Her income this year is low, maybe $28,000 from a part-time consulting gig. That puts her taxable income after the $32,200 standard deduction at virtually zero. She has the entire 10% and 12% brackets sitting completely empty. The 12% bracket for a married couple in 2026 runs all the way up to $100,800 of taxable income. What does Sarah do? She converts $60,000 from her traditional IRA to a Roth IRA. That $60,000 gets added to her taxable income and it gets taxed at 10% and 12%. She pays roughly $6,800 in taxes on that conversion. Now think about what happens if she doesn't do this and just waits. In 5 years, she'll have Social Security income, maybe a pension, required minimum distributions from her IRA that she can't choose not to take. all of that income stacks together and potentially pushes her into the 22% or 24% bracket. The same money taxed at a higher rate because she waited. The conversion today at 12% versus the forced distribution later at 22 or 24% on $60,000, that difference is roughly $6,000 to $7,200. And if she converts strategically for several years during this low-income window, the cumulative savings can easily exceed $30,000 or more over her retirement. That is a real number for doing something she was going to have to do eventually anyway, just doing it in a smarter order. Here's one that surprises people every single time. The federal tax rate on long-term capital gains, investments held for more than 1 year, is 0% for taxpayers in the 10% and 12% ordinary income brackets. 0%. So if you're a couple with taxable income below $100,800 in 2026 and you sell appreciated stock or mutual funds you've held for over a year, you may owe the IRS absolutely nothing on those gains. Let me put a real number on this. Marcus is a 58-year-old high school teacher in Arizona. His wife works part-time. Their combined taxable income after deductions is around $70,000. That puts them in the 12% bracket. They have a taxable brokerage account with index funds that have appreciated by $25,000 since they bought them years ago. If Marcus sells those funds this year, the $25,000 in long-term capital gains is taxed at 0%. Federal tax on that gain, 0. He can reinvest immediately into the same or similar funds. He just reset his cost basis at current prices, which reduces his future taxable gain when he eventually has to sell at a higher income level. This strategy is called tax gain harvesting, and it's legal, documented, and completely overlooked by most people sitting in the lower brackets. Here's where the strategy gets really practical for small business owners, freelancers, and anyone with variable income. Think about it. Not everyone earns the same amount every year. A contractor has a big year, then a slower year. A freelancer lands a huge client in October and another one in January. A small business owner has lumpy revenue by nature. The tax code doesn't care about your average income. It taxes each year independently, which means a year with low income is a window to pull taxable events into that year deliberately. Jason runs a small landscaping business in Tennessee. Most years he earns around $95,000, but this year was slower, around $60,000 gross. After business deductions and the standard deduction, he's sitting at around $35,000 in taxable income. He's deep in the 12% bracket with nearly $65,000 of space before the 22% rate kicks in. What can Jason do with that room? He could take a Roth conversion. He could sell appreciated assets. He could accelerate a client payment from next January into December. He could recognize a deferred gain he's been sitting on. Each one of those moves fills a space that's available this year and might not be available next year when income is higher. The tax code rewards the people who look ahead, not the ones who just react to whatever happened 12 months ago and hope the return comes out okay. Now let's talk about the ceiling. Because filling your lower brackets is a strategy, not a blank check. Every bracket has a top, and crossing it unnecessarily costs you real money. Here's the wall most middle-class Americans need to watch. For a married couple filing jointly in 2026, the 12% bracket ends at $100,800 of taxable income. The 22% bracket picks up right there. That is a 10 percentage point jump. On income above that line, you pay almost twice as much in federal taxes. So if you're at $85,000 of taxable income and you're considering a Roth conversion, a $15,000 conversion still lives comfortably in the 12% bracket. A $40,000 conversion pushes $24,200 of it into the 22% bracket. That overage costs you significantly more per dollar than the conversion inside the bracket. The move is to calculate your ceiling first. Know exactly where the 12% bracket ends for your filing status. Measure your current taxable income against that ceiling, and then fill the space between those two numbers with strategic income. Not a dollar more. This sounds complicated. In practice, it's a 20-minute exercise with a calculator or a conversation with a tax professional. The math is not hard. The awareness is the whole thing. And now here's something the headlines barely covered when it passed. The One Big Beautiful Bill Act, signed into law on July 4th, 2025, created a brand new $6,000 deduction specifically for Americans aged 65 and older. This deduction phases out for individuals with income above $75,000 and joint filers above $150,000. But for retirees with moderate income, this deduction directly lowers taxable income, which expands the space available in the lower brackets. Think about what that means in practice. A retired couple, both 67, has $6,000 more in deductions to claim in 2026. That's $6,000 of additional room in their lower brackets. Room for a larger Roth conversion. Room for capital gains harvesting. Room for income they couldn't have sheltered before this law existed. If you're over 65 and you haven't talked to anyone about how this new deduction interacts with your bracket filling strategy for 2026, that conversation is worth having before December 31st. Because the window for this tax year closes on December 31st, not April 15th. Most of these moves have to be executed before the ball drops on New Year's Eve. Filing the return in April just records what you already did. Here's the simple framework. Think of your lower tax brackets as shelf space that expires at the end of every year. The shelf resets on January 1st. Whatever you didn't put on it in the prior year, that opportunity is permanently gone. Step 1. Know your numbers. After your standard deduction, where does your taxable income currently sit? For 2026, that standard deduction is $16,100 for single filers and $32,200 for married couples filing jointly. Step 2. Measure the gap. How much space is left between your current taxable income and the top of the 12% bracket? That is your window for strategic action. Step 3. Choose your tool. Roth conversion for retirement savers. Capital gains harvesting for taxable brokerage holders, income timing for variable earners, new senior deduction for Americans 65 and older. Step 4. Stay below the ceiling. Never let a strategic move push you into the next bracket unintentionally. The math of filling is only good when you stop filling at the right moment. The people who build real wealth over a lifetime are rarely the ones who earned the most. They're often the ones who kept the most of what they earned. And a strategy as specific and legal and available as bracket filling is exactly the kind of tool that makes that difference. Not in one dramatic moment, but consistently, year after year, while everyone else is just reacting to whatever the tax return says in April. David the electrician figured that out at 54. The question is what age you figure it out. Quick favor. If this video is making one of those tax concepts that always felt confusing finally click into place, go ahead and hit the like button. It tells YouTube this kind of practical finance content is worth putting in front of more people, and it genuinely motivates me to keep making videos like this every single week. Okay, back to it. Because the next section is where the strategy gets really useful for people with variable income. I pinned a question in the comments because I'm genuinely curious. What's one tax strategy you wish someone had explained to you 10 years ago? Drop your answer below after you watch. I read every single one, and some of the best ideas for future videos come straight from this community. Here's the thing about taxes that nobody tells you when you're young. The tax code is not designed to be simple, but it is designed to be navigable by the people willing to learn how it works before April 15th instead of after. The lower brackets are real. The space inside them is real. The strategies we talked about today, Roth conversions, capital gains harvesting, income timing, the new senior deduction, these are not loopholes. They are the intended design of a progressive tax system that taxes different income differently. The only question is whether you use that design on purpose or let it happen to you by accident. David used it on purpose, saved $14,000. And the crazy part, he almost didn't make that appointment with his financial planner. He almost figured he knew enough already. He didn't. And most of us don't. But now you do. The biggest financial wins rarely come from earning more. They often come from keeping more of what you already earn, one deliberate decision at a time. If you found today's video helpful, I think you'll really enjoy my video called The HSA Triple Tax Strategy Most Americans Are Completely Ignoring. It builds directly on what we covered today, specifically how to reduce taxable income even further using one of the most powerful and underused accounts in the entire tax code. I'll see you there.